Welcome back, everybody. If you've been following the markets lately, you might be a little bit confused because companies that have had bad earnings apparently go up, and other companies that have really good earnings apparently go down. And if you're Lululemon, it doesn't matter what you're doing, you go down. So in this video, we're going to talk about McDonald's and Starbucks and their latest earnings report, as well as Valero's earnings and where I should go from here, why Microsoft even dropped after earnings, and then lastly, what in the world is going on with Lulu. So let's go ahead and get started. First off, let's talk about McDonald's, and here's what I said I was looking for. For McDonald's, how are comparable store sales doing? Are they still growing? And did the $5 meal deal make an impact in the US? There's been a lot of articles predicting that they may disappoint with earnings this quarter, so we'll see. And if we take a look at what McDonald's reported, McDonald's had a double miss on earnings and revenue both. And if we look at the details, consolidated revenue was about flat year over year. Global comparable sales were down 1%. In the U.S., down 0.7%. International operated down 1.1%. And international developmental down 1.3%. They had a system-wide sales decrease of about 1%. Operating income was down 6%. And earnings per share down 11%. So of course, that seems like a pretty bad quarter for McDonald's. Yet the market seemed to like it, with McDonald's being up around 4% on the day. A similar thing happened to Starbucks. Starbucks had inline earnings but missed on revenue. And if we look at the details, they had consolidated revenues being about flat, global comparable sales down 3%, with North America and the US down 2%. International was down 7%, and China down 14%. And then their earnings per share was down 6%. So again, a pretty rough quarter, but as of the making of this video, Starbucks is up a little over 4%. So down is up is down. What does it actually mean? Well, we're going to get into that in a minute. But first, let's get back to McDonald's. Now, last quarter, I talked about how I liked McDonald's approach in their earnings call, really focusing on value, and they were about to announce their $5 meal deal. And at least for this initial quarter, the results just aren't really there. But I do realize that it takes more than a quarter to usually turn things around, and so we'll just have to see how they continue doing. But it's also partially that they had a tough comp from the previous year, with Q2 2023 being a really good quarter with double-digit comp sales in every segment and a 24% adjusted increase in earnings per share. Still, though, there are headwinds for McDonald's, and the management team once again doubled down on their focus on providing good value to the customer. Now, in terms of the $5 meal deal, and I will say from personal experience, we love the $5 meal deal because my daughter's home in the summer and we've had a few ourselves. Now, whether or not they make money on it is a different story, because at this point, that part is a little bit unclear. Now, they did say they've seen a lot of enthusiasm about the deal, with 93% of their restaurants committing to extend the promotion into August, and that it's led to an increased guest count, but not yet translated into increased overall sales. So time's going to tell on that one. But in terms of the actual outlook for McDonald's, they maintain their full year guidance, and when you look at their guidance, it might seem a little confusing because it's focused around unit expansion contributing to increased sales, operating margin, interest expense, CapEx, and then free cash conversion rate. So you might be wondering, well, where's the comp store sales measures and where's the total sales and earnings guidance? And so again, this is where McDonald's business model is just a little bit different, because remember, they're not actually a burger company. They're more like a real estate company that also owns and licenses one of the most valuable brands in the world. So their guidance looks more like a real estate company's would, talking about new unit expansion, interest expense, CapEx, and margins. Now, to me, that means their business should be a little more resilient and less prone to volatility, but regardless, their franchisees and the McDonald's brand need to continue to do well. So we'll just see what the next quarter brings. All right, so next up, let's talk about Valero, and here's what I said I was looking for. Now, with Valero, how was their free cash flow generation for the quarter, and how much of that did they return to shareholders in the form of share buybacks and dividends? And if we take a look at what Valero reported, they were in line on revenue and they beat on earnings. And if we take a look at the details, we see that they returned $1.4 billion to shareholders. And if we take a look at the financials to see the breakdown, we see that they had about $2.4 billion in operating cash, with about $1 billion of that going to share buybacks, and the other $350 million of it going to shareholders in the form of dividends. So that's the $1.4 billion in total. And that's something that Valero has been very good at. They've averaged over $1 billion of buybacks every quarter for the past 9 quarters or so. And overall, they've been one of my better performing stocks. The question though, for me anyway, is where do I go from here? And I got this same question in the comments as well, wondering what my strategy for Valero is going to be. And if you remember, this is what I said about it back in January. So the things that I monitor with Valero is the cash flow generation still strong? Is the distribution of that cash to shareholders in the form of dividends and or share buybacks still growing? And from a valuation perspective, is it still at attractive levels? Now you might be wondering a little bit on that one, but because the future growth prospects for Valero, due to the nature of the industry that it's in, are a little bit of a question mark, I'll look at valuation for that company a little bit harder than others. And if it gets to a point to where it's trading at a higher than normal multiple, I may look to trim or sell. And if we just take a look at where Valero's at now, it's not at a crazy valuation by any means, but it's at about double the price to cash flow it was when I started buying it. And of course, it doesn't actually fit my strategy technically, and I'm up about 40% or so on the position, and that's not including the dividends that I received from it over the past 15 months. So I'm actually going to be selling out of my Valero position, and by the time you watch this video, I'll probably have already done it. And it's definitely going to impact my annual dividend number because Valero is one of the higher dividend payers in my portfolio. But I just think it's the right time. It doesn't actually fit my strategy, and it's time to take the win and move on to something that actually fits it better. Plus, the other benefit of cutting Valero is it's a business that I just don't really understand all that well compared to the other things in my portfolio. Like oil and gas and energy isn't really my strength. And so there's a lot of areas of that business where I'm just ignorant about. So as you guys say, it's not in my circle of competence. It's been a great performer for me though, so I couldn't be happier with how it turned out. And now that I'm selling, I fully expect it to just skyrocket up from here because that's normally what happens. Okay, next up is Microsoft, and of course, Microsoft isn't a company that I own in my portfolio, which some of you have actually asked me about. And the reality is, I like them a lot. It's just whenever I had money, there were other opportunities that I thought were a little bit better, and so I never added them. But that being said, Microsoft just reported earnings, and they beat on revenue and earnings both. And if we look at the details, revenue's up 15%, operating income up 15%, net income up 10%, earnings per share up 10%, intelligent cloud business up 19%, with Azure revenue up 29%. So by all accounts, a really great quarter, right? But Microsoft was down about 7% after hours when the news initially came out. Now, they've come back up from that, and we're only down around 1% at the time of making this video, but what is actually going on? Now, if you read all the articles, they say Microsoft slides amid weak Azure growth, and the weak growth was 29%. What? They previously said it would be 31%, and they missed their own guidance. Now, here's the thing. I've talked about this a lot recently, but every reaction in the market doesn't necessarily mean something from a fundamental perspective. I mean, we have very large institutions that are trading intraday or intra-week or just on very short timelines. So it doesn't necessarily mean that there's a fundamental issue or the market thinks that there's a fundamental problem. It could just be people trying to profit off of volatility. And I think the reality for Microsoft and even McDonald's and Starbucks is something very simple. Because Microsoft had a great quarter, but they were also a company at a 36 PE and a 28 price to cash flow, when a lot of high multiple companies are starting to come down. McDonald's and Starbucks, on the other hand, while they had terrible quarters, some of that may have already been priced in. But it's more than likely just a little bump in the positive direction since they've been down for so long. But if their recent performance continues, they're going to continue to go down. And this is why I don't really focus on not buying before earnings or waiting till after earnings like some people say to do. Because look, earnings may shoot the stock up or down, we don't really know. But the idea is that over the long term, the companies that perform well from an earnings perspective should do well from a stock price perspective. And it sounds kind of like duh when you say it out loud, but it's true that not every move means anything. It could just be traders trading, and ultimately the strength of the business is what should matter over the long term. And as much as fundamental stock investors don't like to hear this, the reality is that stock prices in the short to medium term frequently tend to move based on technical factors as much as anything. And you don't have to take my word for it, you can see it in the charts. But the idea is that continued outperformance in the business should override any technical factors over the long run. And again, honestly, talking about this stuff shows why index fund investing is so successful for most people, because they don't have to think about any of this stuff. All they do is continue contributing and watch their account go up over time. But the point is, I wouldn't put too much thought or meaning into what a stock does after earnings. Because Microsoft is still one of the best companies in the world, McDonald's and Starbucks still have legitimate headwinds that they need to figure out, and the earnings reports tell that story, not the market price. I mean, Lulu was up 10% after earnings last time after hours, and in the 2 months since, it's down another 20% or so. And on that note, speaking of Lulu, if you're a shareholder like I am, you might be wondering what the heck is going on. They're down about 50% year to date, and pretty much all the news has been bad news. You have Deutsche Bank, they see competition holding them back. Lulu was downgraded by Citigroup, saying the category has slowed meaningfully in 2024. Then a story came out that they paused sales of their new breeze-through leggings because of mixed reviews and concern about the overall design. JP Morgan then dramatically reduced their price target for Lulu, saying the innovation pause compounds execution risk. And this is on top of all the Lulu is dead and will have negative U.S. growth next year articles from earlier in the year. So it's been a pretty head-spinning few months for any Lulu shareholders out there, but what I'd like to do in these situations is just take a step back and just review what has actually come from the company over the past few months. And basically all we've heard from them is their most recent earnings report, which had revenue growth decelerating but still double-digit at 10%, international growth over 30%, gross margin over 50%, earnings per share growth over 10%, no debt, buying back shares and approved another $1 billion in buybacks. And then obviously the report, which wasn't official, but we heard that they were pulling their breeze-through leggings. But overall, there's a lot of good things in there. The main question that we have to answer as investors is, do we believe that the growth story is over for Lulu? Because if the answer is yes, then it doesn't really matter what any of those other things are if you don't think there's any more growth there. But if you do think there's still growth, then there's a lot of positive things in those comments. Now, obviously, having to pause sales on a new product because it's not being received well is never a good thing. So time will tell how much impact that's going to have on this quarter coming up and future performance. But the reality is that Lulu started the year at a 64 PE and a 32 price to cash flow. And what we've seen is their price and of course their price multiple come down to a, dare I say, attractive looking 20 PE and 13 price to cash flow, which if you compare to some of their peers is starting to look in line. So the question is, do you believe they will continue to outgrow their peers or not? Or is it just a fad or fashion trend that will die or slowly be phased out? That's really the investment question that has to be answered. Now, for me personally, I don't think that Lulu's growth story is over. And I don't think they're just a leggings company like a lot of people online try to act like they are. But I don't know how big of an issue this breeze-through leggings thing is going to be, meaning how much is it going to impact their current quarter coming up and how much of their full year guidance was based on that product being successful. I just don't know yet. But the overarching story for just about all of these earnings report has been the same. The companies with high valuations are coming down, at least a bit, even if it's just in after-hours trading, while companies that have been down for a while are bouncing up a bit, even if they still have problems that need to be addressed. For me, though, the story still comes down to earnings and overall performance of the business, not market reaction, not analyst estimates, not stock downgrades, and not what your Uncle Jeff heard at work from his friend. And as investors, it's up to us to determine if we believe that a story is going to continue or change based on what we think will happen. And the more we focus on that and tune out the other noise, the easier this stuff gets. Now, if you want to see my breakdown of other recent earnings reports like Google, American Express, and Visa, go ahead and click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.